When Dave and I first talked about my doing this, I thought I might do it more freestyle, but then I thought the best gift that I could probably give is a really good, more than a glimpse, hopefully more than a glimpse, of the process that I use and that we use at Market Gauge for determining not only what's going on in the overall economic picture, but also how to make decisions based on momentum, phase, calendar ranges, and we'll talk a little bit about our risk factors that we use. So I'm not going to get specific into picks as I originally thought. This is really, I think, the best gift I can give to you today. So we called it A to Z Active Investing for the Serious Self-Directed Investor. Basically, this is kind of the aha moment I hope you leave this webinar with. What are opportunities for 2025, or at least where can you find them? Considering it is 2025, is the number 5 really relevant? The January calendar range, which is obviously now we're at the end of March, but still very relevant. Why is the yin wood snake? I'm a little bit into the Chinese astrology here because I find it so fascinating, been following it for years. How I use his phases, my navigation system, how I use real motion as our momentum. What sort of risk timing do we look at? And then sector rotation in terms of my economic modern family. Each one of these topics is a full hour at least. So we're going to try to cram it all into the next hour and see how we do. So let's talk about the number 5. So Larry Williams, those of you might be familiar with him. He's been an investor for a long, long time. Actually, I think one of the more interesting things about him is that his daughter is Michelle Williams, the actress. But anyway, he talks about the power of 5. And Yale Hirsch, who's Jeffrey Hirsch's dad, says that every decade, in the middle of the decade, since 1980, 11 out of the 11 times, the 5th year has produced a rally. And so that's sort of been in the back of my mind as we're seeing a sell-off, because is that going to be the case this year? And if so, when is it supposed to happen? So if you continue to look down, it really has been mostly mid-June to the rest of the year where those gains have been made. So it's possible anything can happen between now and mid-June to turn the market around. Do I think that we'll have a powerful rally? Well, certainly from current levels, it's possible. But do I think that we're going to have huge gains on the end of the year? No, I think we may be able to eke out about a 3% gain. But more importantly, if you are a numerologist, as we are, then you can actually look for that time frame at around mid-June based on that 11 out of 11 times to see if perhaps we turn around from wherever we're at. Now, what's also interesting is in the Chinese philosophy, I like to look at whatever the year is in terms of the animal. And you know, there's 12 cycles in the Chinese astrology. And we're in the snake, but we're also, I like to look at the yin and the yang part of it and the element part of it. So we're in a yin wood as opposed to earth, metal, air, fire. Those are the other elements. And what's so interesting is how well this is working out so far. I mean, first of all, you can see in the first part there, it says snakes feel every vibration. Well, isn't that the case here in the market? Except we can substitute the word vibration for headline, and they are practical and cautious. Well, certainly that's been good credos for this year, is to be practical and cautious. And the energy is quieter. You know, businesses are more cautious about hiring. Well, we're certainly seeing a lot of layoffs happening. People preferring to stay at home. We're already starting to see that in the consumer areas in particular. And yet, unlike the year 5, often years of the yin-wood snake turn out to be down years. So that kind of makes you wonder, which way is it going to be? Are we going to have the snake down year, or are we going to have the numero 5 mid-decade up year? And if that's unclear, that's really, I think, the greatest thing to come into this with. And of course, I'm going to give you a lot of clarity as we go on how to make that determination. I also thought it was really interesting that we've been in a water element in the Chinese astrology really for years. And the return of fire happens at the end of 2025 into 2026. So that's also kind of interesting in terms of that's often a prosperous time. But we also look at, if you look at that fourth circle there, it's high temperatures, it's fires, international conflicts. There was even a bit that, this by the way comes from Raymond Lowe, about a lot of airline crashes. So we've seen all of that. And again, if you look at the end, what prospers during this time? Again, this is not 100%, but an interesting guide. Real estate's done okay. Healthcare has been one of the leading areas to be. Obviously, wood industries, we know lumber has gone up, banking is held up, obviously insurance. So, you can, automotive sectors may face challenges. This is before they knew about Trump and tariffs. So I think there's a saying that I'll leave you with before we move on, and that is, millionaires don't follow astrology, but billionaires do. So that's something for you guys to noodle on. Okay, so I don't know how many of you know me. I have been around for quite a long time. Certainly Anka and David have known me forever. And a lot of you might have known me. So I just give you very quickly who I am, because I've been doing this a long time. This is my life, essentially. So I was on the New York Commodities Exchange floor for 14 years as one of the few, considering this is a woman's webinar, I can say this, female traders. There weren't that many of us. Well, among about 1,500 to 2,000 men, I was like maybe one of 6. But I left the floor after 14 years. I got to trade everything from silver, gold, crude oil, sugar, copper, financial futures. It really is where I cut my teeth. And a lot of what I'm going to show you today comes from the lessons that my husband Keith Schneider is the CEO of Market Gauge, and Jeff Bish, who's the president of Market Gauge, we were all down there. I also, right now for Market Gauge, I've been the chief strategist for a long time. We have an asset management company called MGAM. I'm a partner in that. I wrote a book called Plant Your Money Tree. It got to the top 100 best wealth books. In 2023, I was voted one of the best stock educators. I am all over the media very often. And my economic minded family, those of you who might know me also know that I say granny, gramps a lot. That has been my creation as well. So a great financial literacy and way to tell the sector rotation. This is just some pictures of me, just so those of you who don't know me can see how I've been around the media through the years. So let's talk about where we're going to start here. I like to start with the market phases. Now, we did not invent the market phases. This is something that has been written about in different ways throughout the years. So what we've done is we've refined it in 2 ways. Number one is, if you go back to Charles Dow, he talked about market phases, but he only talked about 3 of them. We turned them into 6. And I personally attach these emotions to them because I think it's really important to understand the mentality, the herd mentality of the phase and how that defines what's going on in the market. So clearly, if you start at the top, there's the bullish phase, and that's when everybody's in a state of euphoria. As we know, that markets often die on euphoria and are born out of fear, right? So that's something we can keep in mind. But then we get into a caution phase, anxiety. We certainly saw the anxiety build up as we were in February and now into March. We've gone to distribution, which literally means capital comes out of the market. That's when people get afraid, and we're seeing a lot of that now. We go into a bearish phase, and that's when people go into sort of a state of despair. Oh my God, this is never going to turn around. Our country is ruined. I mean, you hear it all. And that's all the psychology that impacts the market. But what makes us so wonderful as human beings is that we eventually find any reason to return to hope. So then we go into a recuperation phase, then it spreads to optimism, comes back accumulation, and there we go back to bullish. Now you see this in a cyclical fashion. It doesn't always follow so beautifully in a circle, and we'll take a look at a lot of that. But it is important to note where you are in the cycle at any given time. So I wanted to show you here a picture of, this is the S&P 500, pretty much as of yesterday, the 26th. And so you can just see that we measure the phases 2 ways. We use a 50-day simple and a 200 simple day moving average. And that's really actually almost enough. You don't need a lot. I don't like too much on my chart. I like to look at it cleanly. Maybe that's because of my floor experience where I was just basically doing graphing. I was doing point and figure charts, X's and O's, drawing trend lines, and that's kind of all I had. So you start to see price patterns emerge. But nonetheless, it's really a great way to see what's going on. So you can see as we got into the mid of 2024, we were still bullish. We got into a caution phase. We went back to bullish, caution, stayed in bullish till we got into the end of 2024, into the beginning of 2025. And then we went back to bullish. But the other thing you want to look at is the slope. The 50 started to neutralize in slope. And of course, once we broke this at the end of February, and we started to head down in terms of the slope, you can see that we were now into a stronger caution phase, getting into a distribution phase. We had one moment of hope a couple of days ago, and now here we are back down into a distribution phase. So this tells you that you can see, you can even time your way. If I had more time, we could get into that. Like I said, this in and of itself is a whole lesson, but I just kind of wanted to introduce you to all this stuff. So if you want to think more about it, learn more about it, we'll talk about that at the end. So what's phases great for? Well, you certainly from a longer term, you can catch a phase that lasts for years. If you look at the SPY from 2023, pretty much until the end of 2024, it was just in a bullish phase. It was a great swing position. If you want to go into short-term trading, then you can actually catch the momentum as the phase changes up or down, get in, get out relatively quickly. If you're an options trader, you can look at where that moving average is and determine your strike price, how long you want to be in the trade, and of course the stop loss. And day traders is great because you can see, like yesterday, if you saw when the SPY broke down under the 200, you had a really good move down with some follow through today. That could have easily been a day or day and a half trade. So they work no matter what type of trader you are. And by the way, they work for every single instrument there is out there. So now let's take a look quickly at the bearish phase. As again, there's 6, and I can't get into them all with you, otherwise I'll never cover everything else. But I think this will at least give you an idea. So as I mentioned, we look at the 2 moving averages. We look at the 50 and we look at the 200. And so this up here that you can see is a classic death cross where the red arrow is. That's when the 50 crosses below the 200. This you can see is 0708. Probably one of the greatest sell signals that I have ever seen, because it was so clean. Not only did we see the moving averages break down, we saw the price right by the moving averages break down. You literally had one of the tightest risks to go short, or at least a great indication it was time to get out. And as we started to have a little bit oversold correction, that always happens, we couldn't get through the 200. And we went back down under the 50, which a couple of blips here and there is where we really stayed until we started to see the fiscal stimulus coming in the spring of 09. And again, look at how the slope was down, started to turn up as we went into a recuperation phase. And as we broke out over the 200, we got actually a golden cross soon after. It was just clean and beautiful. So you want the 50 to be under the 200 in a bear phase, and ideally you want the price to be under both moving averages. On the antithesis side of that, of course, is the bullish phase. So same 2 moving averages, but we want the 50 to be above the 200, and we want to see that slope going up. This simple physics, momentum, right? If a train conductor is pulling a car with 50 cars versus 200 cars, what's going to stop faster and what's going to gain speed faster? Obviously, the train with 50 cars. So as that's gaining the momentum, you know that so is the stock price and the movement of the stock going up. So same SPY in 2012, 2013, held the 200, got over the 50. Look at that slope. And look, even though it broke it this day, it didn't close below. You got one little blip here, but you knew that was weak because of the slope. That's why I pointed out the slope of our current time. Same thing here. And the 200 hasn't been broken in the SPY for a very long time, briefly in COVID, and may not even been in COVID. I'll have to go back and look at that. The point is, only now are we starting to seriously see that happen. So those of you who are buying down into this dip, instruments that are free falling, That's something that really upsets me a lot because people are quick to tell you to buy the dip, generational opportunities. As a floor trader, we know that you don't leverage down. Compounding is something you do only on the way up and always with trailing stops. Okay, now, it's one thing to see the breakout to the upside or the breakdown to the downside, but what's so great about these phases is that they can retrace and then we can reverse. As I showed you before on the bearish one in SPY, this is Dollar Tree from a while ago. It was just only used as an example because it's so clean and this happens. Here's your death cross. Let's say you said, well, you know what? I don't really want to get short here. I kind of missed the move because the risk up to the moving averages is too far. Obviously, if it clears back over a moving average or back below a moving average, if you're long, that pretty much tells you you're wrong. But in this case, what you often see is a move back up to the moving average. If it doesn't clear and starts to go down, you get another chance and you get a good risk, as you can see that happen. Same thing happened again here. If you recall, Dollar Tree got killed last year. So you can wait if you miss the boat. You don't have to chase down or chase up. You can wait and then get back in. Same thing happens with the long side. This is Solana from Coinbase, just again, because it's a clean chart. But let's say you didn't really want to get involved here while the 50 was below the 200. You had the golden cross. Look how beautiful. The first day it went down to the 50. See how it was above it all here? Right after the golden cross, you didn't want to get long. It was too high up, too far. But look, it came all the way down, it tested it, and the next day, you had the greatest risk, so it was another retrace and reverse. Again, I know this may seem fast, but I want to get to a lot of stuff with you guys today. I just wanted to show you that one of the instruments that we have at Market Gauge, and we've been around for 25, 26 years, and Jeff and Keith and James are the brilliant ones in creating all these indicators. I'm just the educator of them and user of them. I'm probably their greatest consumer. Is this phase change indicator? This is all sectors. So I just wanted to show you that, these are the four indices right here. You can see how negative everything is. What you can see, I don't know how it got cut off, but it got cut off. These are the metals right here: gold, copper, silver. So this is a really great way to look and see whether something is flashing a change of a phase. When it flashes, it means it's just happening. And then how is the overall board? I don't understand how people can be we're going to new highs in the SPY at this time when you see so much bearish flashing all over the place. Okay, so now that's one thing put into your cap, phases. Okay, I want to understand where I am in the navigation cycle. The next one I want to cover with you, and again, I'm sorry, briefly, is the January 6-month calendar range. The years of an administration change is extremely powerful. So clearly, obviously, we were really interested to see what was going to happen in 2025, what was going to break out of the January calendar range, what was going to stay chopping in the middle of it, and what was going to break down below it. And clearly, we saw some interesting things. And again, I could spend a really long time with you just on this, but I want you to get a flavor for it so that you know how I'm looking at things. So this is 2023. So the calendar range is reset every 6 months, but the January one is the most powerful, as I said, in a change of an admin. It will reset again in July. But for now, in 2023, you can see what happened. It broke out, then it came back down. It actually never broke down under the 6-month calendar range low. The second time it went through, if you would have looked at phases at the same time as this, you would have seen that not only was there getting ready for this huge rally, but you can see where it reset here. It then held the July range and then broke out over in July, pretty much till it finally lost its power at the end of 2024. So that's the one viewing I wanted to show you. I also wanted to show you gold in contrast, because you're going to see when we look at SPY, it long broke down under the 6-month calendar range and the moving averages. So gold, for those of you who have just not put gold in your portfolio, not only have you not listened to me, but you haven't listened to a lot of other people. But even if you didn't want to ever listen to anybody, your takeaway, if you learned two things from me today, is it was in a bullish phase. 50 was over the 200, slope was starting to go up. And in the calendar range, pretty much almost right away at the end of January, it broke out and it has not looked back. Gold, by the way, today made new all-time highs. So the calendar range is really good to set what's trending up versus what's trending down. And if you have a look, you'll see even with individual stocks, there are some that are doing better than others right now. And that's, of course, what you want to focus on. Just getting back to my pet peeve, I get really upset when I hear people saying, and we're going to look at NVIDIA later, buy the dip, buy the dip, buy the dip. And you have to say, who are they talking to? People with very deep pockets who can afford not only a 25% drop, but possibly even bigger than that. Whereas I would say, why would you do that? I would rather be looking at things that have been consolidating, strengthening, getting back over either the 6-month calendar range low if they were below, and definitely the 6-month calendar range high, and a moving average changing phase. If you're selective like that, that's half the game right there. You're going to make money. So the next indicator I wanted to give you was about real motion. Excuse me, I'm just going to have a little sip of water here. It's very dry in Santa Fe, by the way, which is where I am talking to you from. So when we were floor traders, momentum was in our blood because we were on the floor. And recently, by the way, on X, I posted some footage from the floor. People must have seen the movie Trading Places. A lot of people have saw that. But this was like real footage, not actors, from Comex back in the day. It was wild. So you knew from all of your senses being engaged when momentum was either dying, increasing, right? So how could you know? The noise level went up. The amount of people in the pit started to increase. You could smell it because people got excited. And so, we don't need to go into details there. You could taste it. I mean, it was almost like with all that action, breath going into the pit. So there was no question that momentum was dying or momentum was shifting. But we at Market Gauge wanted the challenge of trying to figure out how to gauge that momentum sitting and watching screens all day. And that's where we came up with the idea of real motion. So it's a momentum indicator. It definitely is one of my favorite things, and I use it all the time. And I'm excited to show you a couple of the ones that showed you how they work so well. But essentially what it does is what we're looking for is either confirming a trend. So we talked about calendar range, we talked about phases. We now want to confirm that with momentum. So we want to see momentum going in the same direction, or we want to see momentum diverging. So let's say something's been beat up, but now momentum is increasing. We call that a bullish divergence. And if something is gaining, but the momentum is declining, we call that a bearish divergence. So it either confirms, or for lack of a better word, we can say denies what you're seeing in price. So let me show you some examples of that. Jeff teaches this webinar quite often, so you should probably get on the mailing list. It's free, and he'll explain a lot more than I have time to explain right now. But what I really want to show you here is how we use it. So we talked about the 50 and the 200-day moving averages in price, right? What you see here in this cyan line, that's the 10-day moving average. And you can see a bunch of dots here. That's our Bollinger Bands, right? But now let's look at real motion. So what makes real motion interesting is we use the same 50 and 200-day moving averages. But obviously, in terms of the mathematics, they're set, the algos on them are set differently than the way we see it in price. So we use these red dots. And what these red dots tell us is exactly where the momentum is. So if something is going up, like we're seeing this spider here, SPY, then we want to see the momentum going up as well. What we don't want to see, or at least when we do see it, we go, aha, one of those aha moments I mentioned in the very beginning, is when the price is still above the 50. But look at the dots breaking down under the momentum 50-day moving average. What does that tell us? That tells us that momentum is declining. Now, you could decide to do nothing, depending on where you're long. You could decide to take some profit. At the very least, you should probably decide that that's not your moment in time to be adding to your long position. And you can see as this went on, the momentum, the price came back over the 50. The momentum took a couple of days. And look at this, the momentum broke down under the 200 as we were having this correction. So when it got back over the 200, that was your first indication maybe the momentum was getting better, or at least the bleed was done. And if you look at it, it was right here. If you're a short-term trade, maybe you'd have said, well, listen, I'm willing to risk here because it's back over the 10. But if you're a longer-term trader who doesn't even use a 10-day moving average, you could see here when we got through the 50, we were now back through the 50 here, and momentum was doing better. Never doing great, though. The momentum in the SPY I'm going to show you more recently has not been the best. Now, in a bullish divergence, I wanted to show you Tesla. This is a chart, by the way. So right now, this was when Tesla was down. You can see this was not too long ago. Remember, Tesla traded down to 150. And so while Tesla was going down, it was under the 200, it was under 50. This was a classic bearish phase. I don't have the calendar ranges on here, but you could pretty much bet it was down below the calendar ranges as well. This would have been in the January. Look at the momentum. The 50 was having a golden cross here, and the 50 was above the 200 here, and look where the red dots were. The red dots were starting to show a bullish divergence. So I showed you the SPY bearish divergence. Here's a bullish divergence at the time. So this kind of clued us that once this took out the 50 in price, it was a pretty good buy opportunity. And of course, that turned out to be right. And you didn't have to wait for momentum to clear over the 200 it already had. So you could have been adding at this point, pretty darn sure that the momentum was acting in your favor. So again, just to kind of sum up, if something is going up, but the momentum is actually breaking down, kind of gives you a clue that that bearish divergence at least is a sign for caution. And the opposite, if something is going down, but the momentum is flipping positive to a bullish divergence, you want to wait for another signal like a phase change, but it also should make you feel pretty confident that you're getting in the direction of the momentum. So here is another, I don't even have a symbol on this purposely, because I just want you to see here how the momentum also keeps you from getting out of a position too soon, right? So here we have the price of whatever this instrument is, under the 50, it breaks down, it gets back over the 50, breaks back down, but we're saying don't sell. Why don't sell? Look at our momentum. Our momentum broke down here with this, but now if you got in on the basis of the two closes over the 50 and the momentum being over the 50, when this broke down under the 50, the momentum did not. So that's another really good indication that the price sell could just be weak longs liquidating, running some stops, algos filling in, but the momentum is telling you, hey, things aren't so bad. Same thing happened here. We broke down under the 50. We were already under the 200. This broke down but held the 200. Also telling you, I should have a stop, but maybe not being too rushed to a sell. And now, just the opposite here. We got over the 50. We got under the 50. Again, we didn't break down, but here now, the momentum came back. So let's say maybe you even got out a little bit here because you got a bit nervous. We never really got a clean breakdown here. But once this cleared the 50 and this cleared back over the 50, there was your indication to stay with the trade until we got here. Now look what's happening with the momentum. It's starting to break down with the price going up. That's a clue. So it tells you here, don't buy this false breakout. Momentum is declining. Continue to decline. And then again, momentum went back up. This thing sold off, broke down under the 200, went up. So don't just trust that 50-day moving average on price. Also, look at the momentum on the 50 and the 200-day as well. And that really, for me, has been very, very, very important in making trading decisions. So I wanted to show you Alibaba. I wanted to show you a couple of things that don't have all that writing on it, but just give you the essential dots and also combine it with the phase. So this is Alibaba, right? So if you look at this circle right here, the 50 was below the 200, and yet it could not clear. The momentum went right up. So if you got kind of snagged right here, you could see the momentum started to decline when it did not get over that 200-day moving average. So it was kind of telling you maybe it wasn't ripe yet. But then the momentum came back and now cleared over that 200-day moving average just when this cleared over the 50. So after you got those couple of closes, you could see momentum is improving. It was a good time to buy BABA right here. At that point, BABA was only trading about 77. And then it cleared over the 200. The momentum was actually still doing well. So you might have had to have a little bit more patience on an ad, but it paid off. So now look what happened. This was really doing well, BABA, but then we saw the momentum starting to decline here under the 50, and the price was still above. So this might have been telling you time to get out, or at least, depending on where you bought it, put in a no-loss stop or a protective stop. Now, I know this looks pretty active, but one thing we've learned is that this year, the active investor is doing a lot better than the passive investor. And these are all the tools to help you become more successful at that. So now let me show you the difference of NVIDIA. This has got to be one of my favorite talking points. Again, because I've been doing this for a long time and I feel protective over people who really basically made a lot of money just buying NVIDIA for a couple of years and now scratching their head going, yeah, well, I know it's a good company, but why am I losing so much? Well, let's see. Let's see what the indicator, what the real motion indicator told us. When NVIDIA was going up here, and this is 2024, you can see, I was already getting a little bit nervous because I see the momentum peaked, and then it broke down under the 50, long before the price did, but the price broke down under the 50, then it broke down in momentum under the 200, and I'm like, I don't really care. I don't think NVIDIA is the place to buy. And literally, some more mainstream media companies stopped having me on the show because they didn't want, when they asked me, and of course everybody always asks, what do you think of NVIDIA? I'd be like, that's not where I'd put my money. I think there are plenty of other opportunities in the market. Well, where do you think there are opportunities, Mish? Guess what I said? Commodities, gold, silver, but I had a couple of stocks in there as well. And I was telling them, you got to watch the momentum. So then look what happened here. You had the death cross. 50 went below the 200 in momentum. Look where the momentum was. And yet, people were still buying up here, thinking this thing was going to go up. They had to sit through another correction. Oh, yeah, buy the dip. Okay, well, buy the dip. All right, this time maybe they got saved. Bought the dip, it went back over the 50. But notice now, the 50's under the 200. The 50's over the 200 here. So all along, momentum might have improved, but it was still a bearish divergence. So now you had this big move up, and even I started to think, okay, maybe I'm crazy. Maybe NVIDIA is the best trade on the board. But I kept looking back here and going, I don't know, this is still under the 50. The 50 is still under the 200. I'm just going to skip this one. And then guess what? Here, when we started to rally back up again, and the momentum couldn't even get across the 50, and this definitely in the price got over the 50, I'm like, no, do not buy this. And now you can see where the momentum is, and now you can see that this is entered using price right up to yesterday, even weaker today, into a bearish phase. And even though the timing may have not been great, and if you're an active trader, maybe you caught some of this, but if you're looking for that generational opportunity that I hear people on the media talk about all the time, as I said, you better have some deep pockets until this momentum flips to a bullish divergence while this is in a bearish phase. I'm not buying. Okay, same thing kind of happened in SPY. So now I kind of want to put it all together for you. And the good news is I'm actually, well, I still have a lot more to cover, but I'm doing better in time than I thought, because I would love to be able to take some questions and talk to you more about some of these things that I'm talking about at the end. So now let's just at least put together what I've taught you so far. So I've taught you about phases, I've taught you about calendar ranges, and I've taught you about momentum or real motion, right? So let's look at what the SPY has done. Same kind of thing. The 50 here was over the 200. Momentum was looking good. As we got into the July calendar range last year, it took us a while, but we took out that July calendar range. But look what was happening here now. Just as we were doing that in July, momentum was flipping to a death cross. Now that 50 was below the 200, and the momentum was kind of staying above the 50, but couldn't get back over that 200 as this is going up. And all I'm hearing people say is SPY's going to 7,000. And I know sometimes, and this is what makes my experience and my confidence different than a lot of other people, is that I may be early, but often when I see all these things line up, I'm not wrong. So I could see we went to a caution phase. Here we held the 50, caution phase, another caution phase, momentum continuing to decline. And then look what happened. Here's your great January calendar range reset. We broke out. However, this phase is also starting now to diminish in terms of slope going up. It's going more neutral. This slope is going down, and we could not clear that 50-day moving average. We had a strong bearish divergence as people were still super bullish. And then, of course, not only did we break down under the 6-month calendar range high, down under the 50-day moving average, which is now sloping down, we broke the 6-month calendar range low. And now, of course, we also have broken down under the 200-day moving average. And look where our momentum is. It's really weak. So same kind of thing I told you about NVIDIA. There's no reason to buy the dip in the SPY unless you're a much more active trader. If you want to say the worst is over and you want to think that number 5, and yeah, Mish told me in mid-June, the whole thing can turn around. Well, that's just a number that comes out of astrology and the number 5. We know that it could be 11/11, but this year it could not work. Just watch the phase, see if we can get back into a decent phase. Now we're getting into a distribution phase, and see if the momentum can actually start giving us the flip, the bullish divergence. Momentum starts to incline, we get back over the 50, even if we're not over the 50 yet in price. So here's another way with NVIDIA to put it all together, because I kind of explained this to you, but what I did not include in my last slide about NVIDIA was the calendar range. Unlike SPY, by the way, I'm sorry, NVIDIA. I mean, listen, we know AI is the future. I'm just picking on it more because, like I said, A, I get upset that people just keep asking me, when is it a buy, when is it a buy? And B, because so many people can only talk about it, the sexy one, the MAG one. The technicals are just so powerful that I have to pick on it for now. Do I think AI is done? No. Do I think NVIDIA is done? No. But everything in life is cyclical. Everything is cyclical. That's what these phases are all about, the cycles. So you have to wait till the cycle to come back. Don't buy the dip. Wait for the signal. And this is what I'm trying to show you. So look, when everybody was getting super bullish, oh, the analyst upgrades came out. Oh, NVIDIA's going to 250. It's going to 300. Ask Kathy Wood. You got Tesla's going to 2,600. Maybe she'll be right, but, she also, in a bull market, lost 80% of her capital. So she didn't use my calendar ranges because, look, this never broke out over the 6-month calendar range. And I'm not making this stuff up. This is, these are indicators that are consistent. Broke down for a minute, came back, but look, what was already happening with momentum. And now we are under the 6-month calendar range low. So the moral of the story is stay away from things under the 6-month calendar range low and under all these moving averages. I'm not saying there won't be a buy opportunity. And those of you who might be in the future, I could talk about reversal patterns and what they look like. We cannot cover that today. But at least wait for either a phase change or a momentum to calm down or a reversal back through one of the calendar range lows. And I want to also show you BABA here because, again, this is putting it all together. So the phase in BABA, unlike what we just saw in SPY and in NVIDIA, is bullish, right? The 50's over the 200. Here was a great time where we had a convergence. My favorite thing is when we see a convergence. What is converging? We have the 200-day green. We have the 50-day blue. We have the horizontal green, 6-month calendar range high, all converging. And if you thought, well, you know what, I better check the momentum because Mish told me that momentum could be in complete contrast. Look what was happening here with the momentum. The momentum was starting to break out over everything too, and the slope started to look a little bit better, at least it stopped going down. So you had the signal here in momentum as well. Whereas here, it was telling you maybe time to get out of BABA if you were really super long Here again, we saw bullish momentum as this was breaking out of the July calendar range last year. So, actively trading these things based on the phase changes and the momentum is a really good way to try to make some money. Okay, so I don't really have, again, the time to go into what I would love to talk to you more about is determining risk, taking profits. How do you trigger an entry? Is it just on something clearing a calendar range? Is it something on a momentum divergence, or is it just, a phase change? And the answer would be yes on all of those things, but we do like to fine point it a little bit. So I'll just take a moment to talk about this. So you have to listen because I don't have a visual that goes with this. But essentially, if there's one thing else you should know about how we do things is we use the ATR. That's the average true range of an instrument. It's based on the high-low close over a 10-day period. We like to use a 10-day average true range. And what that does is it gives you a sense of the personality of the instrument, right? So if you're looking at something like NVIDIA, that might have a $5 or $6 or $7 range. If you're looking at something like sugar futures, that might have a 20-cent range. But what that does is it helps you decide how many times that average range do you want to risk. So you saw that chart before. Let me go back to this chart. Because I think I do want to really make this point, and I can see I have some time. When we talked about BABA here and the potential buy for BABA, once it clears all of this, if BABA's average true range is about $2 or $3, you can say, I want to risk 1 ATR. I like to risk 2 or 3, depending on the instrument and the time frame of my trade. In this case, I would have said if I was getting in roughly at about 80, let's say, if you can see my calendar range low was at around 77, assuming that might have been about a $3 calendar range, that was a really good risk. That's a clean risk. If you're like looking up here and now you have to risk way more, then you just have to shorten your time frame and use some chart points. But what I'm trying to tell you, going back to the slide, is that not only do we determine our entry based on how many ATRs it is from whatever support level we want to use, but we also determine what our stop is based on that support level and how many ATRs from that support level it is. So we put our stop under there. And then we do the kind of same thing in terms of taking a profit. So if I risk 2 ATRs on a trade, if I get 2 ATRs in profit, so if I'm risking $6 in BABA and I get $6 in profit, I go to a no-loss stop. If I get 2 to 1, say a $12 profit, I may take 25% off. If I get 3 times 1, so I get more like a $15 to $16 profit, I may take another tranche off, and then I start raising my stops. It's a disciplined way for you to approach timing your trades with all of the indicators that I just showed you. So now I want to talk to you a little bit about the macro. So everything that I've talked to you now has been about timing your way in, using phases, using calendar ranges, using momentum, and of course, understanding your risk parameters with using average true range. But do you buy, even if something is set up well, if the market, big view, if the macro is telling you something completely different? Well, the answer might be yes, but at least you're going to be kind of aware. It's like walking into a thunderstorm and you see one little sunny patch over there and you walk over there, but the cloud cover can come that way, right? So you want to protect yourself. And that's kind of understanding that. So another really cool thing that we have at the company at Market Gauge is we use this thing called Big View. And every Sunday, by the way, Keith Schneider and Jeff put together an Outlook, which is available through an email. It's free. And they examine all the risk parameters using Big View. They provide that information, what's risk on, risk neutral, risk off. Plus, Keith does a video which kind of shows you where things are in the risk cycle. It's something that I use all the time. So it's kind of a top-down approach, and it tells you a lot about the liquidity cycle. And again, I'm going to give you more of the abbreviated version of it. But we have these risk gauges. Market internals is part of it. Like, so for example, coming into this week, McClellan oscillator flipped from negative to positive, but we can see maybe that all went away yesterday. So they're short term sometimes they're longer term. Market sentiment, we've been in extreme fear and then we got more neutral. So we want to see where that is. What type of investing? Where are people putting money? We know right now people are putting money into some emerging markets, obviously into the precious metals, into the energy sector. This kind of helps us determine that. And then it tells us what sectors. Remember, I showed you before the phases on the sectors. It tells you all the sectors, but also what the global macro is looking at. So we look all over the world. But the part that I want to show you, I just wanted to kind of give you the broad base of what Big View is all about and what you can look at. But what I want to cover with you today is the key intermarket relationships. And again, those of you who know me know that I've written about this, but it's the relationships between the stocks, the long bonds, the TLTs, the high yield debt, the junk bonds or HYG, gold, and wood. There are other ones, utilities. I'm not going to show you utilities today, mostly because utilities, which is usually a flight to safety, last year had this humongous move higher, along with equities because of the AI data center and the fact that there was a lot of conversation about the energy demand and that utilities were really the transport vehicle for getting electricity to these data centers. So XLU and the relationship to SPY was a little bit more skewed. So I'm not going to show you that today, but I am going to show you all these other relationships right now, what you want to see and why that's so important to know before you go gangbusters into anything. There's a gross versus value. We won't have time for that today either. But what I do want to talk to you is about this one right here. So the first relationship is the SPY versus the long bonds. And I'm just going to move this over here so I can see myself. So what we want to see is in a risk-on environment, you want to see the SPY outperforming the long bonds. Why is that? And I don't know if any of you might be thinking in your head or guessing or writing. As I said, I won't see that till the end. But apparently, the TLTs, even though everybody constantly wants lower yields, and there's something to be said for that, right now we have a unique situation, and this is why the Federal Reserve is sitting pat, because we have Fed funds rate and we have the rate of inflation, whether you believe it or not, flat. And so when the long bonds start to go up or the yields start to fall at this particular juncture, we no longer have a normalization. What we have is a Federal Reserve flashing that they're getting scared. And we all heard, what's his face, Powell last week say, well, the economy could be in contraction, inflation could still be sticky, the mere definition of stagflation. The good news is that we saw the SPY underperforming and we went into a risk off as we saw this massive sell-off recently. But yesterday, and this was made yesterday, we saw that the SPY was starting to outperform again. So that's important because the TLTs are down and the SPYs are down. But if the TLTs are down more than the SPY, it means at this point that we still have a risk-on situation. The other thing is now how the junk bonds are doing against the long bonds. It is important that you want to see the junk bonds outperform the long bonds. Why? Because the junk bonds are where bond traders go in a risk-on environment to buy high yield, high debt, poor balance sheet companies. And they're not going to buy those bonds in an environment where they think the market is going to tank. And one of my favorite stories about junk bonds was that in 2020, before they actually announced that COVID was a thing, the junk bonds started to really crash. So the bond traders were privy to something and they were bailing, and they were right. So for right now, the long bonds, again, for the same reason against the SPY, that are more interest rate sensitive to the short term and also more indicative of how the Fed is feeling about the economy and setting monetary policy, you want the junk bond traders still buying high yield, high debt versus running to safety in the long bonds. So I know that's a lot to hear, but I hope I'm breaking it down for you in a very simplistic way looking at these graphs. So we have two indicators here pointing to risk on. Okay, that's kind of encouraging. So even with the sell-off we're having today, until I see these indicators flip, and they might, as of today, this gets updated every single day. At this point now, I'm saying more correction, not end of days, not recession, not market crash. Again, all the hysteria that we're seeing on social media. Now, the next important ratio is SPY gold. And I guess you can probably know where this is going. SPY is underperforming gold and has been for quite some time. We've had some blips along the way. As you can see, in October 2024, gold took a little bit of a pause. Everybody started getting bearish gold, not me, by the way, and very bullish the SPY. But remember, I showed you the momentum indicators told me, gold still has a good momentum, SPY not so much. And now, of course, you can see that broke down. This is risk off, right? So when gold is outperforming SPY, risk off, whether it's for stagflationary reasons, inflationary reasons, or just the flight to safety that we're seeing because of all the fears that are out there in the market. And another interesting one is wood gold. So there is, people talk about Dr. Copper. And of course, copper had a run recently. It's actually selling off as I'm speaking to you today, but it's done relatively well, copper versus the SPY. However, which would be, right, a reason to think the economy is great. Wood gold, however, wood represents what? I mean, obviously we got a tariff conversation, and so let's forget about all of that. But wood is another great indicator of how things are being built in this economy, right? So if housing is doing well, the economy is doing well. And right now you can see that wood is also underperforming gold. So this is probably our stagflation fear, and stag as opposed to recession, because we're mixed. Interesting, right? Very, very interesting that we'd be mixed like that. And the last, did I say that was the last thing? This is the last thing. So I told you about my economic modern family, right? So this is my baby. I was a special ed teacher for years. I have a master's in special ed. But also as a commodities trader, when I switched to trading equities, because commodities were so dormant for so long, I needed a way to explain everything that I just showed you to myself. So I understand risk, and I understand phases, and I understand momentum, and I understand calendar ranges. But how do I understand sector rotation other than looking at charts? I needed a visual. So I came up with the idea of the family. This is a US-centric family in that some of them are more global, but three are the inside sectors, or what Stanley Druckenmiller called the inside sectors. So if we're going to want to measure how tariffs are going to do, whether we are going to come back to more reshoring and strengthening our own internal US economy and flip our trade deficit, you're going to look at these guys right here. So I'm going to show you a chart of all of them in a moment, but this is regional banks. So regional banks in 2023, when they had that flash crash in March, when all of a sudden commercial banks looked like they were going to fail, they got swapped up, by the way, very quickly by the Federal Reserve, came to the rescue. But that's my prodigal son. And so that explains to me why banking is not a good bet to be against for long term, because like the prodigal son, they always come back, ask for forgiveness, and get it. This is my biotech. This is modeled after Ben Carlson. This is definitely big pharma and represents obviously a cyclical and a non-cyclical. Right now it's in the crosshairs again, unfortunately, of politics because of RFK Jr. and all the threats about the FDA and taking commercials off on pharmaceutical companies from TV, et cetera, et cetera. But again, all you have to know is that if biotech is going down in an okay economy, you have to wonder, what is that a sign for? And if it starts to flip, that's a good sign. This is my matriarch. This is Granny Retail. Now, Granny Retail is probably, to me, besides Grandpa Russell, the most important sector in the modern family. And if you looked at Granny Retail in the beginning of this year, it was already breaking down under the calendar range, under the 50-day moving average, and having a flashing of a bearish divergence in momentum. And I kept saying, if you really want to know what this economy is going to do, what this market's going to do, just watch retail, 70% of the GDP, right? And we know that retail's been really struggling. And by the way, all of these have ETFs. This is Grandpa Russell. People kept talking about the broadening of the market, the going to value stocks. Well, if you're going to see that really happening in this economy improving, you might see it in retail, but you might also see it in Grandpa IWM. That's 2,000 stocks, all of the manufacturing in the US, exactly what this administration is trying to accomplish, bolster the manufacturing here. This is TRAM. This is IYT, transportation. Also super important, often works very much in tandem with Granny, right? Because if people are buying goods, then you can know that the freight and the trucking and then people traveling in the airlines are doing well. But if not so much, then this thing starts to flash warning. This is my sister Semiconductors from Silicon Valley. She was the leader for so long. And I showed you before with NVIDIA, which is in the SMH ETF, having a cyclical downturn. And then finally, here is my Bitcoin character. And of course, Bitcoin is on its own fumes in the modern family, still trying to figure out what it wants to be when it grows up. So now let's just take a look at the weekly charts here. So if we look at all of these charts, we're going to start with the retail. So retail is under the 50 and under the 200 week. Now I went to a weekly chart time frame. Notice everything I showed you so far was daily, only because I wanted to give you and leave you with a perspective of where things might go. So under the 200, under the 50 in a distribution phase in the weekly, what's so interesting to me is if you look at this chart right here and this bar, that was the big down week. So far, all we are is in between that range. So if we broke out over here, would we run into some headwinds? Yeah, but at least that would be really good relief. If we break down onto here, not so great. Whereas Grandpa is above the 200 week and under the 50 week. So this is also ranging between 200 and 210. Again, will we have headwinds? Sure. But if we can get through 210, that would be a really good sign. If we go to biotech right here, you can see that this thing tried so hard to get over the 50 week this year. I was excited about it, but then of course now it's down here, and 130 to me is a really good place for this to hold, or it's big trouble, or get back through 135, and then of course over 140 even better. Semiconductors was literally over the 50-week moving average for 2.5 years. That's what I'm saying. You can love AI, and you can love chip technology, and you can love robotics, and you can love all this stuff that's the future. But that doesn't mean the valuations are there, because it can dormant. It can dormant. I mean, 3D printing is always my classic. That was like the most exciting thing. And then it crashed and it's never come back. Now, I'm not saying about this, but what I'm saying is become a student of cycles, because everything takes a rest. And after 2.5 years, this broke down under the 50-week moving average. Now, look where the 200-week moving average is. That's why I say it's still in better shape than the rest of the family. But nonetheless, keep in mind that sometimes these moving averages become magnets. So if we cannot get a rally going in any of these or here, then you can see how much more downside we can have before things flip. Transportation, under the 50, but holding the 200, kind of similar to Grandpa, doing a little bit better than Grandma. So again, we got to get through 68. That would be a good sign. For a while, this was doing better. This was the old Uber run right here. So it was literally one stock keeping the transportation sector up. This is, I think, more realistic of where we're at. So we're kind of in a caution phase here in terms of how goods, services, and people are moving. Don't want to see it break down under the 200. And interestingly enough, here's our banking. Even though I'm hearing people talk commercial real estate, no good. You know, we're going to see this major crash. Right now, you can see that's still holding up. So before I leave you here, because I see time is going, this is how to reach me. But what I want to talk to you about is anything that might have interested you here. You can go to Mish's Ultimate Trading Program. You can go to www.marketgauge.com/ultimate/VIP, and you'll see a deal for people today. Actually, David, if you could put that in there, that would be great. Or you can just call to speak with Rob Quinn, www.marketgauge.com/call, and he can tell you, there's no obligation, he can tell you about all the stuff I just showed you, and if anything you want to get involved with, hear more, learn more about, that's the way to go. So I hope you really enjoyed this today. I hope you learned a lot, and thank you so much, David and Anka, again for having me on.